Hi, everyone, and welcome back to AI Interconnect podcast. I'm your host, Laurent. This show is where we explore how builders grow real companies in complex industries. AI Interconnect connects funders, operators, and investors. We're shaping the next wave of technology and real assets. Today, I'm joined by Fernando Angelucci, Senior Managing Partner at SSSE, and SSSE acquires and develops self-storage facilities across the US and offer investors access to tax advantages, real estate opportunities. Fernando, thanks for being here. Very happy to have you on the show.
Yeah, thanks for having me.
I'd like to start with your background so listeners understand the path that led you here. And you have a background that blends entrepreneurship, deal making, and long-term investing. Fernando, how did your early experiences led you into real estate, eventually building Triple SC in self-storage?
Yeah, I'm the son of two immigrants that came to the United States, and I was kind of sold on the old school American dream, which is go to school, get good grades, go get a great job at a Fortune 50 company, and work there for 45 years and retire with a pension. Unfortunately for my parents, when I was 16 years old, I read a little book called Rich Dad, Poor Dad. I'm sure a lot of your listeners have heard of it or read it themselves. And that is when I realized that there are other ways to make money, especially if you want time freedom, you want the ability to travel, spend time with the people that you love. So, very quickly, when I went to school at the age of 19, I started my first company. It was actually a painting company where I would paint the exteriors of houses during the summer. And on the weekends during school, I'd go back to my hometown to give free estimates and try to pitch those services for that summer. Fast forward to 2013, I graduated with an engineering degree and went on to actually work at a Fortune 50 company with a pension, believe it or not. But within 6 months, I started doing real estate. And by month 13, I had quit my 9 to 5 job and went full time on the business. So, what we did at that company was basically focused on residential real estate. So, fix and flip, buy and hold for tenants, right? We also did some hard money lending and some contract assignments where we'd actually get properties under contract and then assign our purchase rights in that contract to someone else for a fee. But very quickly, I realized that one of the largest liabilities you can have as a rental investor or as a real estate investor is the people living in your assets. That's usually where most of the problems come, where most of the costs come from. So in 2016, decided to pivot, start sunsetting all of our assets, our single family homes, multifamily homes. We shut down 5 businesses over a 2 year period and started the self storage business. 2018 is when we decided to finally acquire our first investment with our very first investors in that venture. Fast forward to today, 2026, we've done a little over $255 million in self storage. It's 55 facilities across 26 states. We have a little over 900 passive investors, and we've produced around an average 57% internal rate of return for our investors.
That's insane. Okay. Congratulations. I love
Thank
it.
you. Thank you.
This is cool. What was the first moment where you thought this asset class is different?
Yeah. So the very first asset that I bought was a very small facility, maybe 2.5 hours with traffic outside of Chicago. Let's say on a Sunday with no traffic, maybe an hour 15. And that asset was $1 million. So largest acquisition I had made to date. Prior to that, I was more accustomed to playing in the 150 to $250,000 range when buying single family assets and small multifamily. The thing that really changed the way I looked at this business is the amount of man hours needed to run that type of asset. So at the time, we were spending about 4 hours a month on that location in Yorkville. And that 4 hours a month was producing around $2,000 an hour in profitability to us as the owners. So realize that it's a very has the ability to be a very automated business. And the way that the laws are written, a lot of the state laws are in our favor. So, for example, as opposed to habitation based real estate, if someone doesn't pay, they have to go through a lengthy eviction process. In the city of Chicago, they could take up to 8 months to get a non paying tenant out. And then there's no guarantee that when you get them out that they're not going to cause 25 to $50,000 worth of damage by doing some pretty severe things. Self storage is not the case. So it's lien law as opposed to tenant law, which means the second someone puts their possessions into my self storage facility, I de facto have a lien against those possessions. And if they don't pay their rent for a certain amount of days, anywhere between 30 and 60 days, depending on the jurisdiction, the state, I'm able to sell those possessions to recoup my losses. So very low turnover. When there is turnover, a very small amount of lost revenue, if any. And you usually have a new tenant in the very same day that that unit gets cleaned out. So it's very nice that you don't have to waste, on the habitation side, anytime somebody moved out, I had to change the carpets, paint, sometimes change the appliances, redo the flooring. Then I had to pay a realtor to find a tenant to come in. So anytime somebody left my apartment it'd cost me between 4 to 5 months of profitability by the time I got a new tenant in there. And that's just not the case with self storage.
Yeah, definitely. Okay, then what lesson from your early years still shape how you evaluate opportunity today?
Yeah. So one of the nice things about self storage being a commercial asset is that it is valued based on its income generating potential. So the same asset run by two different people can have wildly different valuations. And that's where you create a lot of value. As opposed to, say, when you own a house, if unfortunately your neighbors down the street sell their house for a lot lower during a fire sale for whatever reason, now all of a sudden your house is worth a lot lower, even though nothing has changed. The ownership has not changed, the condition has not changed because of the way that comps work. Because self storage, I have the ability to raise rents and drop expenses. I'm able to go into a facility, pay a very fair price to the current owner that may be a mom and pop investor, which is where the majority of ownership is nowadays, and then professionalize that facility, put in a tech stack, use automations and AI, you have pricing protocols and algorithms, and then have the ability to add it to the rest of our portfolio for scale, which then drops the expenses of that facility. So then you have a much larger net operating income, and over a very short period of time. For example, that first facility that I bought for $1 million, 3 years later, I sold it for $1.8 million, just because of what we did on the operations side and how we implemented technology in order to grow net operating income. So once I realized that there was the ability to kind of leapfrog my net worth, if you will, I wish I would have known this earlier in my life, that I didn't have to start with the small investments, that I could already started by adding 2 or 3 zeros onto the size of my investments, because once they're that large, then you can pay for a large team that's professional, that does everything, specialized. You don't have to do everything yourself. And then that ends up turning into not only a very large return for myself, but also for my investors.
Yeah, amazing. Who tends to benefit the most from working with SSSE operators, sellers, or passive investors?
Yeah, so we have around 1,000 passive investors that work with us as of today. We just launched our newest general partnership fund. So we have been helping a lot of investors, not only on the accredited side, but also the non accredited side. We do some what we call friends and family raises, which are 506B raises, to help them get to the point where they are an accredited investor. Operators, no, we don't really partner with other operators that are running their own facilities. We're not a property management company. We typically will buy that asset and then install our own property management company or a third party property management company to do the operations side. And that's because you're really getting a lot of the value from the purchase, and you just need to go through with the plan. And I'd rather focus on finding good deals that have great financing packages, good sets of investors behind them, and then letting a company that only specializes in property management do that for us. So I'd say, our largest benefit right now is the benefit to our investors. We offer tax advantaged self-storage investments with an emphasis on downside risk mitigation and social stewardship. So that helps quite a bit. We just actually, for example, we just closed on a deal on New Year's Eve that for every dollar invested, $2 to $2.50 in depreciation were passed through to our investors. So it's basically a free investment that if you had any tax issues that year, you were coming up on a pretty large tax bill, you'd be able to invest into our deal. And let's say you owed $500,000 in taxes, you'd be able to put $250,000 into our investment and wipe out all of those taxes that you need to pay later on. So that's one thing. And then I think we do help the sellers quite a bit. What we've noticed about the industry breakdown right now is that roughly 70% of the self-storage facilities owned in the United States are owned by mom and pop operators. These are people that own two or fewer facilities, so one or two facilities. Typically, they're already of retirement age. They may have already retired once or twice before, and they started doing this because they got bored or they needed some additional income. And in half of the instances, we find that the owner itself is spending time behind the desk. So they are themselves operating that asset. So now they're no longer a business owner. They just happen to have a job in a business that they own. So they become friends with the tenants. They start giving them slides on paying late. They don't charge any late fees, auctions, etc. And then eventually they just kind of get tired and they want to go travel. And these self-storage facilities, even the small ones, are $1 million. The larger ones could be up to $20 million. That's a lot of equity to have trapped that you can't really access. So we offer that liquidity to those sellers at a fair price for them to come out, have the ability to have that liquidity, and then move on with the next phase of their life, whether it's travel or retirement or supporting their family, what have you.
Amazing. Okay, what truly differentiates your approach compared to other self-storage groups?
Yeah, so I think the self-storage business, at least our self-storage business, is actually three separate businesses in one. You have the investor relations and equity raising side of the business, so that in itself is a company. Then you have the marketing side of the company, which is finding the self-storage facilities, valuating them, making offers. And then you have the operations side. Well, the operations side we don't do much on. We hire and oversee third-party managers to do that. So where we really differentiate is, I think, in our capital raising side of our business and the marketing side. So let's talk about how we purchase facilities and how it may be a little bit different than what other people do. Most people, when they go to buy real estate, they assume that everyone's really getting the same type of debt, which means that they're all competing on roughly the same type of price for that facility. And what we find is that that's not the case. Yes, if you go out to get third-party debt, there is some variation in rate and leverage, but where you really start getting some really good gains for not only the seller, but then also for us and the investor is when you start going into creative financing structures. So for example, when we make an offer on a self-storage facility, instead of making one offer like most of our competitors do, we make 5 offers. We'll make one offer that it requires us to go get full bank debt. We'll make 3 offers that have some type of seller financing in place. So now the seller gets to collect interest as if they were the bank, allowing them to get a higher total price for their asset. And then we also make what's called a master lease with purchase option offer, which is basically it's a rent to own. So we'll rent the entire facility from that seller. So they get to continue to collect monthly cash flow. Anything above that rent amount, we get to keep. And then we have a preset price that we're going to purchase their facility down the line in maybe 3, 5, 7 years. So those are kind of the 5 different offers that we make. And then that allows us to pay a higher purchase price than most of our competitors because we don't need to rely on bank debt, which can be pretty onerous to get, a lot of underwriting. Here's a perfect example. Right now, if you're going to go bring a cash flowing asset to a bank, you're going to be paying anywhere between 6.5% to 8% in interest. So that's probably going to be a 5-year balloon with a 25-year amortization. It's pretty standard in the market right now. However, when we show that all that extra interest that the bank is earning, that the seller themselves can earn, and if they don't need all of the equity right now, we can structure something that fits for them. So they can be, a certain amount of down payment if they need a little bit of a cash windfall to take care of certain things in their life. And then a monthly payment going forward to, depending on how long they want it, maybe 3 years, 7 years, 15 years, all these things. And what that allows us to do is pay a higher price because then our cost of debt can actually become artificially lower. So instead of me getting let's say a 7% loan on a 25-year amortization with a 5-year balloon, we closed on one that was a 3.5% loan, interest only for 11 years. So all of a sudden now the amount that I'm paying towards debt on that given property goes down quite a bit over the hold period, which means I'm allowed to pay a little bit higher of a price than what most of my competitors would be able to pay if they were going to a regular bank. So not only does the seller win by getting a higher price, they win because they get additional interest payments throughout the period. They no longer have to operate that facility, so they can go, do the next phase of their life, travel, what have you. And then at the same time, we're producing a much higher cash on cash return and internal rate of return for our investors. So I think that's one of the pieces on the marketing side with the acquisitions that we are pretty different than a lot of the other operators in the top 100. On the investor relations side and the capital raising side, I think where we are stand apart from a lot of our competitors are the fact that we report on a consistent basis. We pass through almost all of the bonus appreciation for our investors, whereas in many cases, a lot of the syndicators will actually keep that piece for themselves. So my investors consistently getting anywhere between 50 cents to $2 back for every dollar they invest in bonus appreciation. And then the fact that we're a pretty lean organization. And this is one of the pieces that I refuse to outsource. Whenever a investor has a question, they have my cell phone number. They can call or text me at any time, as opposed to some of these larger funds that you invest in where there's the person that you're talking to versus the person that's actually making decisions. There may be 7 layers of people in between those two. So they're not really paying attention to you. You're more of a number in a spreadsheet than a person that, almost every one of my investors, I know their story. I know what they do. I know where they live, their kids, for people to invest with us because our returns are typically higher than what our competitors are offering. It is a very selective process. And I want to make sure that the investor that I work with aligns with my core values. And I think that's something that's different than what most of our competitors offer.
Awesome. Awesome. At your scale, growth is less about ideas and more about execution under pressure. Right now, what feels like the hardest parts of running and scaling Triple SE?
Yeah. So when you start raising outside capital for your business, you go through these different phases of the type of capital that you have access to and the type of ownership you have to give away for those types of capital. So when you begin, for example, you may start with your own money. You very quickly run out of your own money and then you go to friends and family. Call your uncle, you call your best friends, you say, hey, I got a great idea, pitch in 10 grand or 25 grand or 50 grand. Very quickly, you run out of those people's money. Then you start going to kind of friends of friends and friends of family. So your friends and family, they invest with you because they trust you, not because they trust a deal, not because they trust a track record, because they know you are going to do well by them. Once you do well by them, then they start telling their friends and family. So then their friends of friends of friends of friends of family, they start investing with you because they trust the person that already invested with you that has had good returns. But then very quickly you run out of that capital as well. And that's when you have to really create a professional capital raising business. And you have to start attracting capital of people that don't know who you are, don't have somebody to lean on that they know can give them a confident word on how you're doing or not. So then that comes down to, okay, how am I going to present myself and my track record to instill trust, make sure that I'm mitigating downside risk? Because here's the thing. Everybody wants a return, but what they first and foremost want is they want to make sure they don't lose any of their principal. Once that is taken care of, then you can start talking about what type of returns can you make for them. So at that stage, now you're building out what we call a retail investor funnel. And the retail investors, you want them to get to the point where they like, know, and trust you so that they're willing to invest in your deals. That's usually where most people stop. That's where we like to stay in, is kind of that retail area. Once you're past the retail investment, there's a huge gap. You have to jump up to the next level of check writers, of investors. And that's when you go to the sub-institutional capital, which will be family offices, wealth advisors, or RIAs, registered investment advisors. These are groups that can write large checks, 5, 10, 15, $20 million checks in one stroke for one deal or one fund. But the amount of compliance goes through the roof. And then with that next level, they want you to take more of the risk and they want to take more of the profit, because they see themselves as kind of, without them, you can't really do these deals, right? So you'll see an issue where a lot of people try to skip all of the stages and go straight to that sub-institutional stage. And then what ends up happening is they're hat in hand. They're waiting. The person that the family office they're pitching says no, they have no other options. Whereas if you build it organically from the bottom up, you still have all of these retail investors. Like I said, I have 1,000 retail investors. So if a family office says, hey, we like your deal, we like everything, we just want more of the profit, I could say, this is the deal. You either take it or you leave it, or else I'm going to go back to my retail investors and they're going to fill the entire tranche for me. And then after that piece, then you start getting up into the institutional investors. This is going to be, the people that write 50 million, 100 million, $200 million checks. These are going to be your pension funds, your insurance companies, endowments, big time. And that's not really where we want to go. So what I found is one of the biggest problems is first starting that credibility to start going up that ladder of capital of passive investors. And then every time you have to jump from one level of passive investors to the next one above, then basically everything breaks. You have to change all your compliance. You have to hire additional people on staff just to take care of those people, reporting, et cetera. So that is a big friction point. We actually just we've been in the process over the last 12 months of getting ready for that next rung, which is the family offices, registered investment advisors, the wealth advisors. And that it's a lot of paperwork, it's a lot of compliance, but it does open you to those larger check writers. For example, my retail investors, the average check size is $135,000 per person, roughly. That's the average. Now that I've started having conversations with family offices, their minimum that they're willing to cut a check, they won't cut a check for less than $5 million, right? There are some exceptions to that rule, but for the most part, $5 million to $10 million is the minimum. And that comes with its whole other set of hurdle. So that has been an interesting piece to navigate through as we grow. I'd rather have that problem than the opposite problem, which is having money but not having any deals to put that money into. So we've always been an acquisition-based company. We always focus on our marketing efforts to sellers, direct to sellers. We typically do not buy anything on market or with brokers. And because of that, that allows us to have a very large deal flow, which then attracts capital to us as opposed to the other way around, which would be much harder, saying, hey, I don't have any deals yet, but if you give me the money, I'll go out and find the deals. That usually doesn't work very well.
Wonderful. Thank you. I love all this insight. This is very precious. From speaking with operators across sectors, I see a lot of noise and very few people tracking the right signals. From your vantage points in self-storage, what shift matters most right now, but is still underappreciated?
Yeah, so self-storage has historically been a laggard when it comes to implementing technology. Still is to this date. Now we're starting to see a large amount of private equity funds coming in to the vendors and services around the self-storage space, buying up technology companies that have a lot of data from their management softwares, insurance companies. Even the implementation, I know AI is a buzzword right now, but even the implementation of artificial intelligence and sequences inside of the self-storage softwares. So for example, something that the airline industry has done for 40 plus years, which is dynamic pricing, self-storage has never had that. A 10 by 10 unit is X or $100 a month, regardless of if it's in the middle of the summer or in the middle of winter, or If someone is renting that facility because they're moving a house, so it's going to be a short term versus someone that's going to use it as an external closet. But now we're starting to see implementation of that technology where, for example, we use a certain software that does kind of three main things that is pretty amazing. So number one is dynamic pricing. It will it will see seasonality, it'll see the occupancy of competitors, it will see how often people are Googling self-storage in a certain geo-tagged location. And if it all of a sudden it sees a spike, let's say on Googling for self-storage in Chicago, you see a large spike in percentage of that keyword hitting, it can automatically adjust the pricing on our site to capture some of that increased demand at a higher profit number, just like airlines, right? If you try to book a flight 3 days ahead of time, that's going to be a lot more expensive than booking it 6 months ahead of time, right? So that's one of the things. The second thing is the ability to analyze current customers for increases in monthly rent. So, for example, the software can go through and say, hey, let's score everyone from a score of 1 to 10 on how likely they are to absorb a price increase on a monthly basis. Maybe the guys that are, pay late every month and pay in cash, and there's always issues, most likely they're not going to be the ones that absorb that price increase. But if, let's say, someone pays on an Amex credit card, Platinum, every month, it's on auto credit, they have an open social media that you can see online traveling first class, and they're in Europe or in the Bahamas, et cetera. That person most likely is not even going to notice an increase on their monthly statement, right? So that person would be scored a 10. And then what the software will do, it will along those 1 to 10, it'll say, hey, here's how much we recommend increasing the rent on this tranche of numbers. So 1 to 3, no price increase, 4 to 7, moderate price increase, maybe, $10. And then 8, 9, and 10 will increase their rent pretty substantially, maybe 30% increase or 50% increase in their rent, knowing most likely that they will not move out. So extremely interesting technology that is now available for operators. But this 70% of mom and pop owners that are the largest percentage of owners in the United States, most of them are not using these technologies. Some of them don't even have websites yet. So some of the things that are still undervalued, but produce massive gains when it comes to increasing the bottom.
Yeah, it's incredible. I love it. And it is clear you've been intentional about how fast and where you grow. Looking ahead 12 to 18 months, what does success realistically look like for 3SE?
Yeah, so our company operates on somewhat of a 3 to a 5-year cycle. We build up and acquire assets. We end up stabilizing those assets, and then we put them into portfolios of, 10 to 20 facilities at a time. Here's the reason why we do that. Those small facilities, those one-off facilities, the big guys that have the big checkbooks, the ones that are publicly traded, they don't really want to waste their time buying $1 million or $2 or $3 million asset. They want to spend large amounts of cash all in one go because it's the same amount of overhead, right? You got your analysts working on it, due diligence, et cetera. So it doesn't scale linearly. If you increase the purchase price by 10x, the underwriting and the amount of overhead and man hours may only increase by 2x or less than x. So there's an opportunity to be in the feeding chain, if you will. Get a lot of these smaller facilities that no one's going to touch that are, at the professional level, increase their size, run them professionally, put in systems and processes, procedures, get them to the point where you can hand it off as a stabilized asset that's almost like an armchair investment, it just runs itself. And now that, what I may have bought for $1 million may be worth 3 or 5, let's say. And I put a bunch of those, let's say 10 of those together. And now all of a sudden I have a $30 million portfolio of 10 of these assets. Now that becomes very enticing to those publicly traded real estate investment trusts that are willing to spend the big dollars. And because they have big dollars, their valuation or their return on their investment, usually the parameters are lower than someone like myself. So when I'm buying something looking for a 18 to 25% internal rate of return on my money, one of these larger operators may be looking for a 12 to 16% return on their money. So there is an arbitrage there just by being able to create larger portfolios of the same assets. So the whole is larger than the parts, if you will. So that is a huge opportunity right now in our space. I also think that the ability to run your business on these somewhat 3 to 5 year hurdles, if you will, allows you to do a lot of very prescient tax planning. So I know that in year 4 to year 5, I'm going to have a very large gain. So how do I start accumulating paper losses right now to basically offset that large gain that I'll get? So it's basically a net zero taxable event. So for me, what is progress? What is success look like over the next, period, this next 3 to 5 year cycle? It'd be we're right at the end of our third portfolio that we're building. So selling that off in the next 12 months. We just launched our first GP fund that gives general partner economics to the limited partners, giving them access to parts of our business that have never been available before. So that is a $15 million target raise with a $25 million hard cap. So our the first GP fund is somewhat small. So getting that fully funded over the next 2 years, which is our investment period, that would be a success for us. And then, returning capital with great returns to our investors, and then hoping that when we send them that check, they just push the check right back across the table and say, rolling into the next one, right? I'm happy with the performance. So, we're always trying to, our investments are illiquid. You're buying physical real estate, so you can't get in and out like you can in the stock market. Something goes wrong, you press a button and you cashed out of your position by the end of the business day. That's not the case with us. So we need to be able to provide a return that is well and above what the market is, because the market's a liquid asset versus our is being a liquid. And for us, if we can hit, what we've been doing over the last seven or so years, we've had an average of 57% internal rate of return. If we can at least double what the stock market is doing for our investors and then offer tax benefits alongside that you can't get with paper equities, I think that's a huge success for us.
Yeah, fantastic. Okay, I love it. What are you deliberately choosing not to do right now?
Yeah, there's a lot of shiny objects always
Yeah.
floating around, right? So we used to have a lot of different companies that did a lot of different things because there's a little bit of profit available in all of them. And what we find is that when you are an operator that does not specialize in one asset class, you really are a master of none of them. And you get mediocre to sometimes even negative returns. So, you know, for us, we've been presented with many great opportunities in different asset classes: apartment buildings, mobile home, assisted living, industrial, flex space. And what we found is that we just need to keep our head down and focus on what we're experts at so that we can be the best at that individual asset class. So, deliberately saying no to anything that doesn't fall into our 3, in our 10-year plan, making sure that we're focusing on not only the existing assets, but then increasing the deal flow of those types of assets coming into our business. So just trying to avoid the shiny object syndrome and, staying laser focused on what we do.
Yeah, very true. Very true. But if you had fewer constraints, what will you
Yeah. So we are currently looking at assets that operate extremely similar to self storage, but aren't technically self storage when it comes to the customer base. So, for example, right now, the majority of our facilities are geared towards a residential customer, someone that they have too much stuff at home, or they're moving between jobs or houses, or they're downsizing, et cetera. What we realize is that our best tenants are our commercial tenants, which in most cases are less than 20% of our total tenant base. And these are going to be your small business owners, right? Your contractors, if you will, the HVAC company, electrician, carpenter, the guys that they have a small operation. They may be a one-man show. Maybe they got a couple employees, but nothing big. They don't have enough money to build out their own space. So what we found is on our residential side of our self-storage business, the largest units that we have are 10 by 20, maybe 10 by 30. So 200 to 300 square feet. But we've seen this massive demand for slightly larger than that, 30 by 50 or 50 by 50. So these 1,500 square foot to 2,500 square foot units that these small business owners and contractors are able to utilize. And what we saw is this is a direct effect from the pandemic. So during the pandemic, everybody started shopping from home because you couldn't go out, right? And what ended up happening is a lot of these companies that are in the logistics and shipping businesses took over those small 1,500 to 5,000 square foot locations that were usually reserved for these small businesses. So the small businesses were priced out of the market because of this last mile shipping spread, because everybody wanted to be able to click, I want to buy this product on Amazon and I want it to show up tomorrow morning, or even in some cases, depending on what municipalities are in, show up same day. And the only way to do that is to have a massive network of last mile shipping. So these guys now have been priced out of the market and are willing to pay much higher rates on a square foot basis than originally, because they're competing against the Amazons of the world, right? So what we found is that we can run this business just like a self-storage business, month to month contracts. The only difference is we need to just make the units a little bit larger. So instead of a, 10-foot wide by 30-foot deep, we make it 30-foot wide by 50-foot deep. And that allows us to capture these tenants. And then instead of a regular, 6x7 door, we put up maybe a 14-foot by 10-foot door that allows them to pull in, let's say, a work vehicle and make this somewhat of like their shop. And what we found out is that these types of tenants stay much longer. They're usually likely to prepay their rent 1-2 years in advance, just because they can't absorb an increase in rents, which is great for us. When people don't move out, that's always a great thing. And they typically only move out for two reasons. Either the business failed and they got to shut it all down, or the business is doing so well that they're able to buy their own warehouse or build their own warehouse. Both those situations, usually means that someone's going to last in that unit for a pretty long time, especially with what we've seen in what's going on with AI, right? AI is not going to be able to unclog your toilet. It's not going to be able to build you furniture. These are the businesses that for right now, I think are pretty safe from those jobs being taken over or misplaced by artificial intelligence. So we want to bank on that fact and move into this side of the world of what we call pro storage or contractor storage.
I love it. Thank you. Thank you for everything. Great insights. Thank you for joining. Insight into your journey, your industry, and the work you're doing at SSSE. Thank you so much, Fernando, for
Yeah,
joining,
thanks for having me
being
on.
here with us. And
Absolutely.
it could be a good idea to do it again, maybe a year from now,
Yeah,
and we'll see what happened.
let's put something on the
Thank
calendar.
you. Wonderful. And that's it for today's episode of AI Interconnect. And if you enjoyed it, share it with someone who's building the future, or better yet, someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you, Fernanda. Ciao.
Thanks for having me.